What will it take for an ETF to be approved? What's the difference between an ETF and an ETN? And how will they both impact the market? Those are the topics we'll be covering in this video. First up, this is not financial advice. I'm going to flash up the full disclaimer now. Please pause the video and read it. Without any further ado, let's begin with my first question, which is why there hasn't been an ETF approved as of yet. So what's your opinion why there currently isn't one then?
Well, it's primarily related to the risk disclosures. So first and foremost, you have to solve the custody and the execution issues. And you have to be able to make sure that it is a very valid offering. And the biggest pitfall there is that a lot of custodians today are not offering insurance. So even if you talk to Bitcoin Swiss, which everyone uses as the go-to for a custodian for some of their assets, you talk to Bank Frick, everybody uses Bank Frick for their custodian of their assets. They will not get an insurance policy to insure the assets in the vaults that they have. So automatically out the door, gone. No regulator is going to sign off on that. So that's part of the problem that we're working on solving. The other part of the problem is the reason behind any prospectus offering is you have to be able to fully impart onto anybody in the world that they know exactly what they are investing into. Now with an ETF, a traditional stock ETF, it's relatively straightforward because any grandma and grandpa down the street, any 18, 19-year-old that has, I don't know, in the US, a 401k or something, they understand what a stock is. They understand what a bond is. Or if they don't, then their high schools and colleges failed them miserably. But nobody understands truly what blockchain is, or at least those that are outside of the industry. So there's the added layer that not only do you have to disclose in a prospectus offering for a crypto ETF, the business risks associated with perhaps the underlying companies behind these cryptocurrencies, the financial risks, just because it's an investment, you have to also then add on additional financial risks because this is a quote-unquote alternative investment, at least for the foreseeable future. But you also have to add in disclosures very likely around technology risks, that people understand what the blockchain is, why there are certain risks in blockchain because wallets can get hacked. There are certain risks around the custodian themselves. There are risks in execution. There are liquidity risks. There are more volatility risks related to the blockchain than there would be in traditional financial markets. There are market maker risks. There are manipulation risks, which we see almost on a daily basis with some OTC traders. So that's just additional disclosures that have to be built in, that we're having conversations with the regulator around to figure out what they should be, how they should be portrayed, such that anybody, if they read through the whole document, which of course nobody's going to do anyway, but should they want to, they'll fully understand exactly what it is they're investing into.
Okay, so in your opinion, there's two things. Do you believe custody solutions are far enough along for an ETF to be realistic? And I've forgotten the second one, so come back to me.
Maybe it was on the execution side or the market manipulation side. We do, because we already have the custodian solution built for the top 20 cryptocurrencies, which will be what is around the very first fund that we're putting together, which will be launching in Malta, the Maltese PIF that we're doing. There are already single wallet solutions and single custodian solutions that can offer for up to 20 cryptocurrencies. Our solution is we're bringing together multiple custodians rather than just a traditional one custodian to be able to capture the top 20 cryptocurrencies. And we'll actually be the only fund in the world that can offer that type of exposure, whereas others are mostly stopping at top 10.
Okay, I've remembered the second part of the question. That relates to regulated exchanges. Do you not believe that we need a fully regulated exchange before an ETF is realistic?
Well, I'm not planning on it. I actually view regulated exchanges a bit differently than people in crypto do. I do not believe it will be current crypto exchanges, except for maybe a small few that have already scaled, that will even have the ability to be regulated exchanges. I do strongly believe it will be the incumbent exchanges that rather just integrate the blockchain technology, integrate cryptocurrencies into their already existing offerings, because institutional investors are already asking for it as we speak. They'll be integrating that ecosystem onto their exchanges rather than it being a quote-unquote regulated crypto exchange that will offer securities or fund vehicles on those exchanges. And the reason is this. One, too high a barrier to entry on the regulation side. A lot of them will fail just because they won't be able to solve that issue. But the biggest issue is where the money is. It's going to be very, very difficult for someone to convince JP Morgan or Goldman Sachs to leave their accounts, to leave their trusted market makers at one of the ICE groups, like the New York Stock Exchange. It's going to be difficult to convince them to leave the NASDAQ. It's going to be difficult to convince them to leave the London Stock Exchange or Deutsche Börse, to be able to move their capital that they trade with to a crypto exchange. The only people you might be able to see this happen with might be Binance, just because they have the money to throw at it right now, and they have Malta, which in itself is a bit of a benefit right now, and GBX, the Gibraltar blockchain exchange, because they are owned by GSX, an already licensed institutional stock exchange. And they've been far and ahead of the game for a very, very long time. When I met Nick Cowan, their managing director, at the end of last year, him and I hit it off perfectly. And they've been working on that ecosystem, seeing how security offerings and seeing how these funds would be the future of the space. So that's why I think most of those crypto exchanges will have to remain decentralized or unregulated if they want to survive, because it will be the incumbent players that are the mainstays in that space.
Okay, I completely take your points. What kind of time frame do you envision for that?
Oh, well, NASDAQ said they wanted to have something in 2019, so I'll trust them there. We'll see. ICE said that they were looking into exploring it as well. London Stock Exchange hasn't announced anything. Deutsche Börse is still internally deciding what their future blockchain strategy will look like, although they're very, very open to it. Mm-hmm. GSX, the Gibraltar Exchange, you already know their view. They're fully on board. Malta's fully on board. Börse Stuttgart, the second biggest exchange here in Germany, has already announced that they're starting their own token sale platforms, that they're starting their own security token listings in 2019. And that is probably the biggest exchange in Europe right now that has formally said, we believe in this, we're pushing this forward. The difference between an ETF and an ETN is the ETF itself actually holds the underlying, the cryptocurrencies, where an ETN, an exchange-traded note, investors invest into a note, which is the underlying. And then the note is the counterparty exposure risk to the underlying assets themselves. And then the underwriter of the note guarantees the performance of the portfolio class, in this instance, the cryptocurrencies. So that's actually available that we could do in Q1 if we wanted to. The difference is that the investors, the retail investors, invest into the debt instrument that has a guaranteed performance tracker to the fund itself, rather than holding the underlying itself. Which, you know what, sure, we could do that, but I strongly believe that if you're investing into something, you should be able to say, you know what, I actually own that Bitcoin, I own that Monero, I own that Litecoin. Right? Rather than saying, I own a piece of a bond that some bank gave to me that is saying that they'll track the performance of Bitcoin, of the index, right? Mm-hmm. So that's why that would be the fallback option. So we already have the plan in place in case the ETFs don't come to fruition.
Do regulators view ETFs and ETNs very differently? There's obviously a lot of talk, particularly in America at the moment, with the CBOE trying to get an ETF approved. And an ETN, as you say, if it doesn't buy the underlying cryptocurrency, it's nowhere near as bullish for the market. But if you're simply an investor who just wants to get exposure to cryptocurrencies, it's very similar. So is there a big difference in regulatory standpoint?
Well, so from a regulatory standpoint, even though they're relatively similar, they are different from a prospectus filing perspective, right? Because an ETF actually holds the underlying. So you have to disclose the business risk, the technology risks, the custodian risks, et cetera, because the investors are directly investing through the fund into the underlying instrument. With a note, an exchange-traded note, an ETN, they're not investing into the Bitcoin. They're not investing into the top 20 cryptocurrency index. They're investing into a debt instrument. So now the disclosure is not around the technology. The disclosure is not around the business risk, but rather disclosure is around the counterparty risk. Because let's just hypothetically say the ETN is for $100 million. $100 million is guaranteed in principle by the underwriter of the instrument, the bank in this instance, most likely. And that bank has to guarantee the performance of the index, whether it's losses or whether it's gains. Mm-hmm. Now, the risk is, let's say this. Hypothetically, let's say we're in a situation like 2017. I open 100 million ETN in January, and in December, the ETN is going to close. Well, that ETN, based on us tracking that index performance, rose 1,900% in value. So do you actually expect that the bank will be able to pay out that much return on that instrument to that investor at that time? So you have to disclose that counterparty risk. Now, that disclosure is actually a lot easier to do, and it's relatively straightforward. It's formulated. It already exists. So we could go live with the ETN at the drop of a penny if we needed to, but there is still something more tangible and more fundamentally recognizable in an ETF because you directly hold the underlying.
If you're issuing an ETN, you're effectively in a negative situation if the market's going up, because as you say, you don't own the underlying cryptocurrency, but you do have to pay potential gains. Why would you want to launch an ETN then, if you believe cryptocurrency is going to go up, which I assume you do?
Well, you do participate in the gains, because theoretically, what the bank should have done to guarantee the performance of the principal of the instrument, they should have invested that 100 million into the index itself. Therefore, they have the liquidity to be able to pay off the performance of the principal of the note. So you still get, theoretically, the exact same upside, the exact same potential. It's just less tangible because you don't actually own the underlying. But you're guaranteed the performance of the underlying. So you're still guaranteed the same percentage return, the same way you'd be guaranteed the same percentage loss. But the other side of this is you're paying an interest on the note itself, because there will be a fee that you have for underwriting the outstanding amount of that principal during that period of time, which just adds additional costs. And now we're probably getting very, very technical.
No, it's great to hear. To be honest, I'm actually learning a lot from this. This is very fascinating. So can I just clarify then, with the ETF and the ETN, the bank, from a counterparty risk sense, they have to buy the underlying simply because, as you say, if it goes up a ridiculous amount, they'll never be able to pay people who bought the ETN. But the ETF, the main difference is that if you've invested into ETF, you actually own it. Whereas the ETN, the bank buys the underlying cryptocurrency, but you don't own it through owning the ETN. Is that kind of correct?
You have no claim to the underlying. Your claim is to the debt instrument itself. And that's where you can see the risk comes into play, because your counterparty might just default on their obligation, right?
Yes.
So that's why an ETF is the ultimate goal, because you take out that counterparty risk. But an ETN would allow us to get to market in Q1 very, very easily. However, based on the conversations we've had, we do believe that we still can stick to our goals of having the ETFs ready in Q2, Q3 next year.
Okay, why do you think there's such a push towards ETFs then? I know, as you say, it's definitely preferable to have an ETF, but an ETN, to me, almost seems like a stepping stone in a way. There's such a huge rush towards an ETF in America at the moment. Why not towards an ETN?
But for the exact same reason I highlighted, counterparty risk.
I mean, if you have say if you had like a massive institution, wouldn't they be able to, what's that, sorry?
Like a BlackRock. So if you had a BlackRock, people won't question that counterparty risk.
Yeah.
But what will happen is BlackRock, to be able to secure that instrument, will charge you an arm and a leg, which means that from a financial perspective, just because of the expense ratio on that note, it might not be worthwhile to invest, because the basis points on securing that note might be very, very high. And of course, you're not going to trust a small investment bank that might have, I don't know, 100 million in net worth or 100 million in net asset value, because how the hell are they going to secure a note for $100 million, right?
Yeah. Okay.
It's a difficult situation, which is why some smaller groups are currently trying to launch ETNs and not necessarily getting the fundraising done, because nobody's getting valid counterparties right now. We've had some very, very intriguing conversations with some very noteworthy institutional banks, but that would only be as a last resort if we can't do the ETFs.
And that is the end of the excerpt from the interview. I sincerely hope you've enjoyed watching this and learn a thing or two as well.